Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is clinic debt consolidation, refinancing medical practices in Vancouver. When you've layered term loans, equipment leases, lines of credit, and supplier payables over years, each with its own rate, maturity, and covenant, it can strain cash flow and distract you from patient care. Strategic refinancing consolidates and reshapes your obligations into a single optimized facility, freeing capital for growth, technology upgrades, or simply smoother operations. Here's how to execute it in Vancouver's healthcare market. Babi. Step 1. Audit your entire debt profile. List every liability. Term loans on imaging suites and EHR systems, mortgages or leasehold improvement loans, equipment leases, lines of credit, supplier payables, and any vendor financed balances. Key metrics. Note balances, interest rates, maturities, payment schedules, and covenants for each facility. Identify where rates are high, maturities are soon, and cash flow mismatches occur. 2. Set your refinancing objectives. Lower all-in cost. Lock in today's competitive fixed rates, ideally prime plus 0.5 to 1% on all amortizing debt. Extend or align terms. Move from varied 1 to 5 year maturities into a unified 7 to 10 year term that matches asset lives, e.g., 7 years for imaging, 10 years for real estate improvements. Simplify servicing. Replace multiple payments with one monthly draw and one covenant package, reducing administrative burden. Improve flexibility. Add an interest-only draw period or a small revolving component for unexpected OPEX needs. 3. Refinancing structures. 1-1. Single-term loan consolidation. Bundle all term loans, leases, and mortgages into one amortizing facility at a fixed spread. Negotiate a 6 to 12-month interest-only window to ease transition. 2. Term loan plus revolver hybrid. Core term loan covers fixed amortization needs. Add a small secured revolver, 5 to 10% of total, for working capital draws against receivables or equipment. Revolver interest only on used balance. 3. Sale leaseback top-up. Monetize part of your paid-off imaging or lab assets, MRI, CT, autoclaves, via sale leaseback to boost cash for top-up if renovation or EHR implementation is planned. 4. Vendor-backed recapture. If you have captive financing on certain equipment, negotiate a full payout at refinance and fold that balance into your single facility, eliminating a higher cost stream. 4. Choosing lenders and getting bids. Local banks and credit unions. Vancity and Coast Capital know BC healthcare cycles and regulatory nuances. Specialty healthcare lenders. Non-bank finance firms that underwrite complex consolidations quickly. Bus DBA capital markets options. For large groups, consider a private placement or medium-term note issuance to institutional investors at favorable spreads. 5. Covenant design and negotiation. Debt service coverage. Model pro forma cash flow post-refinance. Target 1.25x coverage. Leverage ratios. Negotiate senior debt EBITDA tests with a 10% buffer for billing or referral cycle variability. Flex triggers. Include a springboard waiver allowing a one-time covenant reset during EHR go live or facility expansion. 6. Execution roadmap. 1. Preparation, weeks 1 to 2. Compile audited financials, debt schedules, receivables aging, and equipment appraisals. 2. Term sheet solicitation weeks 3 to 4. Solicit and compare at least 3 term sheets. Evaluate all in spreads, fees, prepay rights, and covenant flexibility. 3. Due diligence and closing weeks 5 to 8. Finalize legal documents, confirm payoffs, draw the new facility, and retire legacy debts in one coordinated close. 7. Post refinance management. Monitoring dashboard. Set up a simple dashboard tracking outstanding balance, covenant headroom, and draw availability. Strategic prepayments. Use surplus billing inflows or asset sale proceeds to prepay voluntary principal and reduce total interest. Annual review. At each anniversary, renegotiate spreads or consider shortening term if cash flow allows. By auditing your obligations, consolidating into a tailored term loan, and if needed, a small revolver while negotiating flexible covenants, Vancouver clinics can simplify debt servicing, lower costs, and unlock cash for growth or technology upgrades. I'm Haider Malik. Thanks for listening, and here's to stronger finances and better patient care.